In 2008, while millions of Americans lost their homes, a small group of hedge fund managers made billions betting against the very mortgages destroying their neighbors' lives. One of them walked away with $3.7 billion in a single year. But here's what nobody talks about. That was just the beginning. Today, hedge funds don't just bet on markets. They own your apartment building. They decide if your local hospital stays open. They influence which laws get passed in Congress. And most Americans have no idea it's happening. The question isn't whether hedge funds have power. It's how they got it, why nobody stopped them, and what happens when entities controlling trillions of dollars answer to almost no one. This is the story of how a financial innovation from 1949 became the invisible hand shaping American life. To understand how we got here, you need to know what a hedge fund actually is, because the name itself is misleading. In 1949, a sociologist and financial journalist named Alfred Winslow Jones had a radical idea. Instead of just buying stocks and hoping they'd go up like everyone else, what if you could protect yourself against losses? He created a fund that would buy stocks he believed in while simultaneously shorting stocks he thought would fail. This hedging strategy, betting both ways, was supposed to reduce risk. Jones called it a hedged fund. The name stuck, even though modern hedge funds rarely hedge anything. For decades, hedge funds remained a niche corner of Wall Street. They were exclusive clubs for the ultra-wealthy, requiring minimum investments of $1 million or more. The government classified them as private investment partnerships, which came with a crucial advantage. They faced almost no regulation. No regular reporting requirements. No limits on leverage. No restrictions on what they could invest in. The logic seemed sound. If you're rich enough to lose $1 million, you don't need protection. But three things changed that would transform hedge funds from boutique investment vehicles into economic superpowers. And the first one started with a man who would become a legend. George Soros didn't just make money. In 1992, he broke the Bank of England. Soros's quantum fund bet $10 billion that the British pound would collapse. When it did, he personally made $1 billion in a single day. The British government lost twice that amount trying to defend its currency. One man had defeated an entire nation's central bank. This wasn't just a successful trade. It was a demonstration of power that changed everything. Suddenly, hedge funds weren't just investment vehicles. They were geopolitical forces. And the money started flooding in. In 1990, hedge funds managed roughly $40 billion. By 2000, that number hit $490 billion. But the real explosion was still coming. The second transformation came from an unexpected source: pensions and endowments. Yale's endowment manager, David Swensen, pioneered a new approach in the 1990s. Instead of sticking with traditional stocks and bonds, he poured money into alternative investments, including hedge funds. The results were spectacular. Yale's endowment grew from $1 billion to over $20 billion during his tenure. Every institutional investor wanted to copy the Yale model. State pension funds, the retirement money for teachers, firefighters, police officers, started allocating billions to hedge funds. University endowments followed. Even sovereign wealth funds representing entire countries joined in. But here's the crucial detail everyone missed. These institutional investors weren't just clients. They were bringing legitimacy and scale. When a state pension fund invests $500 million with a hedge fund, it's not just money, it's a seal of approval. And the third transformation? That came from changing the definition of what hedge funds could buy. In the early 2000s, hedge funds started moving beyond stocks and bonds. They bought distressed debt, loans to failing companies. They acquired private equity stakes. They purchased real estate portfolios. Then they went further: water rights, farmland, toll roads, entire industries. The 2008 financial crisis was supposed to destroy them. Instead, it made them unstoppable. When Lehman Brothers collapsed in September 2008, the global financial system froze. Credit markets seized up. Banks stopped lending. Companies couldn't make payroll. The crisis threatened to spiral into another Great Depression. The government's response was unprecedented. The Federal Reserve slashed interest rates to nearly zero and would keep them there for 7 years. They pumped trillions into the financial system through quantitative easing. The goal was to save the economy. But there was a side effect nobody anticipated. With interest rates at zero, traditional investing stopped working. Savings accounts paid nothing. Bonds returned almost nothing. Pension funds that promised 7% annual returns to retirees couldn't hit their targets with safe investments anymore. They needed returns. Hedge funds promised returns, and they had cash to deploy. Between 2009 and 2015, hedge fund assets under management nearly doubled, from $1.4 trillion to $2.9 trillion. But the money wasn't going into the stock market anymore. It was going into real assets, things people need to live. Private equity firms and hedge funds went on a buying spree. They purchased entire chains of nursing homes, medical practices, and hospitals. They bought up single-family homes by the tens of thousands, converting the American dream of homeownership into a permanent rental relationship. They acquired mobile home parks, where residents own their homes but rent the land underneath, making them essentially captive customers. In 2012, Blackstone, the world's largest alternative asset manager, began buying foreclosed homes in bulk, sometimes purchasing 1,000 houses in a single day. By 2020, institutional investors owned over 300,000 single-family rental homes. But the real power move was in corporate debt. As interest rates stayed near zero, companies borrowed unprecedented amounts of money. By 2021, U.S. corporate debt hit $11 trillion. Hedge funds and private equity firms didn't just lend this money. They bought the loans, giving them direct influence over how companies operated. When a hedge fund owns your company's debt, it can force restructuring, demand asset sales, or push for layoffs. It's control without ownership. The consequences aren't abstract. They're playing out in American communities every day. In Youngstown, Ohio, a hedge fund-backed firm bought the local hospital in 2020. Within 2 years, they'd cut staff, reduced services, and extracted millions in management fees. By 2023, the hospital was on the brink of closure, leaving 200,000 residents without emergency care nearby. This pattern repeats nationwide. Research from the University of Pennsylvania found that when private equity firms acquire hospitals, patient mortality increases while profits soar. The firms achieve this through systematic cost-cutting, reducing nursing staff, eliminating unprofitable services, and loading facilities with debt. In housing markets, the impact is even more direct. A 2023 study found that in neighborhoods where institutional investors own more than 20% of single-family homes, rents increase 7% faster than comparable areas. These firms use algorithm-driven pricing that responds to market demand in real time, meaning rent hikes happen faster and hit harder. Perhaps most disturbing is what happened with surprise medical billing. Private equity firms discovered they could buy physician staffing companies, place their doctors in hospital emergency rooms, and then charge out-of-network rates that insurance wouldn't cover. Patients would receive bills for thousands of dollars for emergency care at in-network hospitals, because the doctor treating them worked for a private equity-owned staffing firm. This practice became so predatory that Congress finally banned it in 2020. But it took years of patient bankruptcies to force action. The common thread? Hedge funds and private equity firms optimize for extraction, not sustainability. They're designed to maximize returns over 5 to 7 year investment periods, then exit. What happens to the community afterward isn't part of the calculation. So why hasn't anyone stopped this? The honest answer, they've tried. And they've failed. Repeatedly. The Dodd-Frank Act of 2010 was supposed to reign in Wall Street after the financial crisis. It created new oversight, stress tests, and capital requirements for banks. But hedge funds aren't banks. They successfully lobbied to remain classified as private partnerships, avoiding most new regulations. Some states have attempted intervention. In 2023, Minnesota considered limiting institutional investor purchases of single-family homes. The legislation died in committee after industry groups spent millions on lobbying and argued it would restrict housing supply. The SEC has proposed rules requiring more transparency from private funds, disclosing fees, performance, and conflicts of interest to investors. As of 2024, these rules face legal challenges and remain unenforced for many funds. Even when regulations pass, enforcement is the problem. The SEC's Private Funds Unit has roughly 50 employees overseeing an industry managing over $20 trillion in assets globally. That's one regulator for every $400 billion. The political influence is staggering. In the 2022 election cycle, the securities and investment industry spent over $500 million on political contributions and lobbying. That's more than the defense industry. more than pharmaceuticals. And here's the mechanism that makes it nearly impossible to fix: the carried interest loophole. Hedge fund managers pay the capital gains tax rate of 20% on their earnings instead of the income tax rate that tops out at 37%. This tax treatment saves the industry billions annually, and it's the one benefit they'll defend at all costs. Every attempt to close this loophole has failed, because the people writing the laws depend on the people benefiting from it. If this sounds familiar, it should. We've seen this pattern before. In the 1890s, John D. Rockefeller's Standard Oil controlled 90% of America's oil refining. He didn't just own the product. He owned the railroads that shipped it, the pipelines that transported it, and the distribution networks that sold it. He had vertical integration, so complete that competitors couldn't survive. It took 2 decades of public outcry and a Supreme Court ruling to break up Standard Oil in 1911. Today's hedge funds don't need to own 90% of an industry. They just need to own the debt, the real estate, and the political access. The control is more subtle but equally effective. Consider this. As of 2024, the top 100 hedge funds and private equity firms manage over $10 trillion in assets. That's roughly 40% of America's GDP, controlled by entities that face minimal regulation and disclose almost nothing about their activities. BlackRock alone manages $10 trillion, more than the GDP of every country except the US and China. When BlackRock CEO Larry Fink writes his annual letter to CEOs, markets move. His company's investment decisions shape which companies survive and which fail. But here's what makes the modern version more insidious: it's distributed. There's no single monopoly to break up. Instead, there are thousands of funds, each operating independently, yet collectively reshaping the economy in the same direction, toward asset extraction and away from productive investment. The data tells the story. In 1975, American companies paid out 25% of earnings to shareholders through dividends and buybacks. By 2023, that figure exceeded 100%, meaning companies are paying out more than they earn, funding the difference through debt. Who owns that debt? Often, the same hedge funds and private equity firms demanding the payouts. This isn't capitalism in the traditional sense. It's financialization, where making money from money becomes more profitable than making things or providing services. So what do we take from all this? First, understand that financial innovation without oversight leads to exploitation. Hedge funds started as a way to reduce risk through hedging. They evolved into largely unregulated entities that can take unlimited risks with other people's money, including the pension funds of public workers who have no say in the decision. Second, when essential services become investment vehicles, communities lose. Healthcare, housing, and infrastructure aren't like stocks. They can't just be traded for maximum return without human cost. The invisible hand of the market doesn't build hospitals in rural areas or maintain affordable housing. Those require different incentives than quarterly profit maximization. Third, complexity is a feature, not a bug. The hedge fund industry thrives on being opaque. Complex fee structures, offshore entities, and proprietary strategies all serve to hide what's actually happening. When you can't understand how the system works, you can't reform it. Here's the uncomfortable truth. Hedge funds control America not through conspiracy, but through systematic advantage. They have more information, better access, longer time horizons, and fewer restrictions than any other economic actor. They're not breaking rules. The rules were written to accommodate them. The question we're left with is simple but profound. In a democracy, should entities that answer to no voters, publish no data, and face no meaningful oversight control trillions in assets that determine whether communities thrive or decay? We broke up Standard Oil because we decided that much concentrated power was incompatible with a free market. We created banking regulations after the Great Depression because we learned that unchecked financial speculation destroys economies. History suggests we eventually act, but only after the crisis becomes undeniable. The question is whether we're already there, and we just don't see it yet. If this story concerns you, the most powerful thing you can do is understand where your money goes. If you have a pension or 401k, find out if it's invested in private equity or hedge funds. Ask your state representatives about transparency in institutional investing. Support legislation that closes the carried interest loophole and requires disclosure from private funds. Because right now, the most powerful forces in American finance operate in the shadows. And they prefer it that way. If you found this video valuable, subscribe for more deep dives into how money really works in America. Next week, we're investigating how private equity is quietly taking over veterinary care, and why your dog's checkup now costs as much as your own. The system is complex by design, but understanding it is the first step to changing it.